What is happening, guys? We are here for the July edition of our real estate rundown. A lot has happened over here in the last 90 days, and I think it's got a lot of people with a lot of questions. I know we're commonly getting those questions. Kind of excited to dive into this, just show you a little bit on the back end what we're seeing, some of the reports that I'm reading, and give you guys a real good sense of where we're at today. Right, guys. So, for anybody who don't know or tuning in and watching this, my name is James Adams. I am the founder and team leader of the Adams Group. We're a team of realtors that are dedicated experts to help people buy, sell, and invest in real estate. This report here could apply to anyone because one thing I truly believe in my heart is the better educated I can make you, the better off you're going to be in your journey, whether that be selling, buying, or investing in real estate. So, a common topic right now is economic slowdown. It's all over the place. We're seeing it in every different way you can imagine. But what does that really mean? And we're going to dive into that here today. Talk more about what that means for the real estate market. But I really want to start out with a couple of topics that are coming up and in play. This word right here is coming back around. Recession fears surge among CEOs, survey suggests. Three-quarters of all global CEOs say we are in a recession or will be in the next 12 to 18 months, according to a new survey. So, what does this really mean? I wrote down a couple of notes here. I looked up some definitions for you guys. A recession is 2 consecutive quarters of negative GDP. I really want to make something clear, though, is that typically to get us out of a recession, in our country, housing is a tremendous force in our economy. And housing is actually what leads the way out of recessions and in all of our past recessions. So I do believe that we will see that again here. Throughout history, during a recessionary period, interest rates go up at the beginning of a recession, but in order to come out of a recession, interest rates are lowered to stimulate the economy forward. I want you to stick there for 1 second. Historically, we have seen a repeat uptick in interest rates followed by lowered interest rates. So it's coming from the mortgage specialist. I believe that's Wikipedia. But let's really think about that and how those two things can line up. So we're coming into a recession, which typically has something to do with inflation. So in order to fight inflation, they increase interest rates. But what happens after that typically comes a recession. And in order to re-stimulate the economy, housing is going to drive us out of there. I don't want to go too deep on that. I'm not an economist by any means, but it makes sense when interest rates are lower, there's more money flowing around the economy. Here's that exact graph, guys. We're going all the way back. This is really small if you're watching this on your phone, but let me just break down some of what this is. So this is going all the way back to the 70s, all the way up to 2022, where we are. This is January of 2022. These gray bars are the recessions that we've experienced in the past. And the cool thing to notice here is that it matches up with the data. As you lead into the recession, interest rates go up. And then to come out of the recession, interest rates come back down. Up, back down. Up, back down. Up, back down. Up, back down. Coming in another one, we're going up, right? So I do believe that there's a couple of things that we're going to address here. And I want to just table this for a second because in a second here, we're going to talk about should I buy a home right now? And when it comes to the word recession, I feel as though it's an emotionally based word. I personally was 18 back in 2008, right? So I can't claim to have gone through this or experienced it, but I was there and I look back on the history and it was terrible. Let's just be honest, it was terrible, and it was heavily tied to what happened in the housing market there. But typically, over times past, that is not actually the word recession and a crash, bubble, whatever word you want to use, are not actually typically tied. It just happened that way in 2008. And I want to show you. Here's that same exact graph again, which is pretty cool to notice, right? If we start into a recession, we're going to go up. As we're coming out of the recession, interest rates are going to go down to stimulate the economy. There it is again. Over the past 5 recessions, mortgage rates have fallen an average of 1.8% points from the peak seen through the recession to the trough. And in many cases, they continued to fall after the fact as it takes some time to turn things around, even when the recession is technically over. This is from Fortune. And that, again, makes sense. Here's the graph that I really want you to focus on, because my job, and I deal with this all the time. When it comes to recession, it's emotionally based word. When it comes to buying a house, it's an emotionally based decision. And this is commonly where I find myself to be the leading advisor, where I help people the very most, right? Is when you find someone that is an expert advisor and you can trust them to help you in your journey. From there, you can focus on the thing that really matters. It's, is this the right house for my family? Is this where I want to live? But how do these two things have anything to do with each other? They are both triggers, right? So recession is like, oh my God, something's going to happen in the housing market. Should I buy a house? Is a super scary thing, because ultimately I feel as though everyone is afraid of purchasing at a bad time, right? But let's just focus on one thing here. Recession over the years is not really related to whether the house goes up or down. It's all over the place. This was the perfect storm, right? So this is where we're going to tie into things. We're going to start going into what's happening in the market, and then later we're going to go into, is now the right time for you to buy a house? And I really want to tie back into that second thing. It's going to come up there, and really like how to make that decision for yourself. But first thing is, everyone always wants to know what's going on with the inventory. What's going on with the inventory? So on a generalized level, like this is the easiest way to conceptualize it. We can go into some numbers, but we are seeing less offers received. We are seeing less offers over asking price. We are seeing less sales, and we are seeing more inventory. And we're going to dive into a little bit deeper of what that really means. But this here is across the board. Let's look here what Mark Fleming has to say, chief economist. There has been a pickup in the inventory that we've seen recently, but it's not from a big increase in new listings. Pretty big point right here, but rather a slowdown in pace of sales. And remember that a month's supply measures the inventory of sale relative to the pace of sales. Same inventory, fewer sales means more months of supply. So here we go right here. We already started to experience back March, April, May. The data will always lag, right? Like the data always takes a little while to process for us to get caught up to today. But we're seeing an increase in those months' supply of inventory, which is ultimately a good thing. What we have been doing, a normalized market is 6 months of an inventory, is a normalized market. The last 2 years have been incredible. If you have been a seller, or really any point, you just couldn't believe it at any point. A buyer early that decided to sell again, it's been amazing. The market has performed incredibly. But let's get real, guys. Could we really continue to appreciate at 20 to 30% a year? Like who would be buying houses, right? Like this doesn't take very long to stack up at 20 to 30% per year before it gets crazy. Like that type of appreciation is unheard of. And it was amazing for the last couple of years. But now we're going to start to see a moderation in appreciation, not a depreciation, a moderation appreciation. We're going to get into those graphs and break that down. Here we go. New monthly listing counts. This here is year over year. So as you can see, we're actually up in new listings. And when that is coupled with an increase in interest rates like we have seen, an increase in interest rate is very simple. It limits buying power. And with the cost of the house, it really is going to lead a lot of people to put this plan on hold for what usually an emotionally based decision, right? Because if they're going back to renting, they're really paying 100% in interest. But as we look here, we're seeing an increase in new listing count and a decrease in the amount of pending sales. That means that we're going to have inventory that's starting to stack up. Beautiful thing, guys. Beautiful thing. On the buy side, it means that you have more options. You know how many people that came to us over the last 2 years? And I remember a story with one of our agents. They had to write 17, no jokes, 17 at or above asking offers before they got one accepted. That is insane. And that comes because of lack of inventory. There was no houses to choose. Every buyer was fighting for the same house. Now we're going to see inventory come back, and now we're going to see a more normalized things. On the sell side, your house is still worth an incredible amount because of the growth over the last couple of years. The shift now is that you can't take pictures of it with your cell phone and list it in one of the big websites for sale by owner. You're going to need somebody who's a dedicated expert to market your home. And that question even continues on. Like for us on our side, this business is going to become a skill based business again, where you want the person who is best at exposing your property to the market. But at the end of the day, your property is still incredibly valuable after the last couple of years. Existing home sales. So this right here is a prediction from NAR for the year. The year count is going to be 5,400,000. That is down from last year. But the thing I want to tie in here is this is very similar to pre-pandemic norms, right? We're going back to a normal market. Last year was gangbusters, insane, right? So all this means is that we're going back to a pre-pandemic norm. Home sales have essentially returned to the levels seen in 2019 prior to the pandemic after 2 years of gangbuster performance. This is so well said, right? This is not the end of the world. This is just normal, right? We're going back towards normalcy. What we have been through is not normal. Here's from Danielle Hill, the chief economist at Realtor.com. Active inventory continued to grow, rising 21% above a year ago. In other words, we're starting to add more options, but the market needs even more before home shoppers have a selection that's roughly equivalent to the pre-pandemic housing market. This is the stacking. This is where inventory continues to go up. This was interesting. So Realtor.com had to come up with an updated forecast for 2022. They originally forecasted for 2022 to have a 0.3% increase in inventory. But after interest rates changed and market conditions changed, they actually updated to where we're going to have a 15% increase in active inventory. Beautiful thing. Buyers have options. Buyers don't have to, write an offer on every single house. And you have back on markets. There's a lot of people that have just went and hid under a rock for the last 2 years because they were just getting tortured on the market. And now is a time where they can actually choose the house that they love. Here's from Mark Fleming again. We should start to see less competition, fewer bidding wars, and therefore less upward price pressure. In fact, a simple analysis shows that 1 month increase in the month supply results in a 3% decline in annualized house price growth. And our preliminary house price index is already showing moderation in housing prices in April. What this is saying, there's a lot of big words in there, is instead of going like this, right? It's going to go like this. That's not crazy. This is controllable. This right here leads it to where your 3.2 in the middle of Spring Hill is 750,000. And nobody wants that. It's not realistic. It doesn't make sense. And there are markets like that. And there's a lot of markets like that in California. All right. So the second emotionally based topic, guys, I'm going to give you the facts. And from there, it's for you to decide. But I want to make sure that you're making this decision from solid ground, right? That this is where I feel like our role is as experts to help you, is to give you the data, look at it from the perspective that we're at. I can tell you that a lot of people that know me, you can look for anybody who I can send you a list of people that you can talk to that would refer me, is I always come from the heart. I don't have the ability to sell anything that I don't believe in. Never in my life have I. So if I'm going to advise you and your family, I really get to know who you are, what you're trying to accomplish, what your timeline looks like, because this is a huge decision that you're about to make. And I want to make sure that I believe in it just as much as you do. But let's break away from the emotion. Let's take a look at some of the fundamentals of how you make this decision. So part of this problem is I was on Fox News. I woke up the other day. I had one. They're all over the place right now. The cooling housing market enters into the great deceleration. Home prices decelerate as the housing market downshifts. Buying a home at the wrong time can backfire big time. Here's why it may pay to wait. Guys, this is fear-mongering, interest, like it's a hot topic right now. This isn't telling you anything, right? The great deceleration, it's a really fancy term for we're not accelerating as quickly. There's a moderation and acceleration. But what does that really mean? Like what happens if I wait is what we really want to dive into. This graph is very small, especially if you're on a phone, but I want to relate this to what it means for you. Like, what is deceleration? Deceleration is when supply increases, demand can stay the same, but when supply exceeds demand, all of a sudden we have more options. These two graphs are breaking down showings in Spring Hill. It just chose a market that we can base this off of. If we look back to January to February, and we're looking at the top graph, your $200,000 to $300,000 house had an average of 16 showings per listing, and today that same house, 200 to 300,000, has an average of 7. Right, so we have half the foot traffic. We have half the amount of people that are looking at things, and that can be balanced from multiple things. Maybe that one buyer just didn't see that house that they would have seen before because there was no inventory. They have more choices, right? This is a good thing, you guys. Absolutely a good thing. See some comments coming in. Melissa, I love you too. Miss you. And guys, if you have any questions for me as I go through this, I would love to answer those. That's the most fun part of this for me. So please don't be afraid to drop those in the comments. This right here, I just showed you to show you that there is more chance of you getting the house that you love. Decelerating home prices do not mean depreciating home prices. Craziness right there. This whole thing is hard to wrap yourself around. But if you're going up so fast and then we just decelerate, we moderate, and how quickly that the prices are increasing, that is a deceleration, but you can still have an appreciation with a deceleration and appreciation. Ugh. Here we go. All the big dogs across the board right here see an appreciation for 2022. Even though we're seeing moderation, we're seeing price reduction, we're seeing all these things, keep in mind when you're seeing all these price reductions, we're coming out of a market where it almost didn't matter what you listed for. If you were within the realm of what the house should sell for, it was probably going to sell. Now they step out of this, and now people are thinking that people are still willing to overpay for houses, which was happening. 106%, 107% of market value. All that's showing you right now is that this is not the market position. Oh, we're connected. That you want to get yourself in position to expose it to the full market. Buyers have more choices. That price craziness is gone. So now you have to price it correctly, market it correctly, and make sure that you are exposing this to the entire market. Here we go again, home price performance. This is just what the big dogs are saying. So when it comes to thinking about this decision, how does this apply to should I wait? Should I stay or should I go now? Whichever way you want to look at this, is you're looking at a market where, yes, interest rates are higher. There's nothing saying that interest rates are going to go down, at least in the short term, right? Short term, they're still talking about going up to fight inflation. We know they're going to come back down because it's what leads us out of the recession. Is the housing market will drive us out of there, and that starts with the lowering in interest rates to increase the amount of people that will move. But you're also fighting appreciation, right? Appreciation is still determined, like it's still expected from all the big dogs. So what is crazy about buying now before the appreciation comes? Yes, you have the higher interest rate. You can refinance that in the future. That is not, you're not married to that, right? But why would you want to wait to buy it where it's going to be more expensive according to all the experts? That does not quite make sense. And also, if you're comparing this to rent, guys, just keep in mind when you are renting for 100% interest. No arguments, nothing. Like you are paying a landlord, you are getting nothing in return besides a place to stay where you could be in your own house and working towards home ownership. David Ramsey always coming with something crazy. The root issue of what drives house prices almost always is supply and demand. Now, interest rates affect that. When interest rates go up, guess what? Fewer buyers. The demand goes down, thus prices are going to soften or not be as cray-cray as they have been before. And that's what we're seeing right now. I think this is super spot on. It's exactly what's happening. We're having a moderation in acceleration. And that comes from the interest rates that are softening the prices. There's a lot of people that dropped out. That interest rate went up and their budget went from 350 to 310 real quick. And they didn't like what they saw at 310. So, what does that mean for you? Again, more opportunities in order for you to find the right house for you. Pretty cool graph here, guys. And this is something that's really going to come into play. I'm actually seeing it right now. I just choked myself on this. So, what this is the 50-year average for new constructions created. If we go back to the 70s, there was a boom. There was a lot of cities are open up, houses being built. And this continued to be a major force right around '08, and things got a little crazy, right? So then after '08, there's a lot of building houses. This created a lull in housing. There's a housing shortage that we've still had, and we are just now getting back to the 50-year average of new constructions being constructed. This is awesome, you guys. We have better choices here. They are super efficient. Most of these builders are offering a lot in closing cost incentives. It's a perfect time to have a lot of those out there because a lot of our buyers that are coming out of the woodwork now are the ones that fought to get a house before. They were your 3.5% down FHA, your VA, your USDA, the ones who had to come up with a creative way to move into a house. And that's the people I really love to help, right? Like those are the people that it's the most fun to work with because they're coachable and it's fun to be creative in a market where you're averaging 103% of the list price as what you have to offer to get it. There is nothing that you can do that's creative. It's very, very small what you can do. So it's really cool to see them be able to come back on the market and tie them into new construction. You can walk them right into a brand new house, get them in there for there's ways we can get you in there for absolutely nothing, but they're more difficult. But we can get you in there for very little money in comparison to buying a house, and it's definitely not 20% down. All right, I do believe that this is our wrap-up slide. From Realtor.com, experts don't believe the market is in a bubble or a crash is in the cards. Like during the Great Recession, the nation is still suffering from a housing shortage that has reached crisis proportions at a time where many millennials are reaching the age when they start to consider home ownership. That's likely to keep prices high. So we've got a huge group of people that are reaching that first-time buyer age right now that's going to continue to drive, right? So we still have those buyers that are there. And it's, again, just showing you how we're going to continue to appreciate just in moderation. Guys, if you tuned on here, I really appreciate you guys tuning on and listening. And yeah, if you have any questions whatsoever, you can find my contact, shoot me a messenger, like whatever I can do to help you guys. I'm always here. And if you have any questions about whether or not this is the right decision for you, I would love to speak about that and see if I can help.